If you've ever looked into a reverse mortgage, you've probably heard a lot of conflicting things. Some of it sounds helpful, some of it a little scary, and most of it's honestly incomplete or just flat out wrong. So, in this video, I want to walk through the 8 most common myths about reverse mortgages and give you the facts so you can actually understand how these work and how they might play into your life. Now, before we jump in, quick clarification on this. When people say reverse mortgage, they're usually referring to a HECM, a home equity conversion mortgage. That's the FHA insured version available for people that are at least 62 years old. It's the most common and it has built-in protections that a lot of people don't even realize exist. This first one's probably the biggest one that I hear. Myth number 1, if you get a reverse mortgage, the bank owns your house. Fact, you still own your home. Your name stays on title, just like with a traditional forward mortgage. What's actually happening is this. You're using the equity in your home. Lender places a lien on the property just like any other mortgage. The loan gets repaid later, typically when the home is sold or sometimes after you pass away. But ownership, that never transfers to the bank. This next one's interesting. Myth number 2, a reverse mortgage doesn't even apply to me if I don't already own my home. Fact, you can purchase a home with a reverse mortgage. It does take a considerable down payment to do this, usually about 40 to 50% or sometimes more, but buying with a HECM allows you to have no mortgage payment from day one. This is something we see people do a lot in retirement years when they want to downsize or relocate to be near family. I'm actually working with a client right now that is selling her $1 million home in Southern California and moving to Arizona to be near her family. And she's purchasing the home in Arizona using a reverse mortgage. So starting on day one, she will not have a mortgage payment on this new home, but she also doesn't have to spend all of that cash that she got from selling the home in California to do that. Myth number 3, reverse mortgages are risky and people lose their homes all the time. Fact, HECMs are no riskier than traditional forward mortgages, and in recent years, the default or foreclosure rate on HECMs has been less than that from forward mortgages. To stay in good standing on a HECM and make sure you never run any issues, you do need to do a few things. Number 1, you have to live in the home as your primary residence. 2, you have to pay your property taxes. 3, you have to maintain homeowners insurance. And then finally, you have to make sure the home stays in reasonable condition or good repair, basically that it's not condemned or condemnable. That's it. If those obligations are met, the loan just simply continues. It's not a hidden trap, it's a structured product with defined responsibilities, all of it's heavily regulated by the federal government. Myth number 4, a reverse mortgage wipes out all your equity and leaves nothing behind. Fact, the majority of homes with a reverse mortgage on them, they maintain a sizable equity position, and some people even see their equity increase after they take out a HECM loan. Here's how it works. First, you're limited on the amount of equity you're allowed to borrow against based on your age at the time the loan is originated. Additionally, the federal government restricts how much equity you're allowed to pull out of the home in the first year. So this limits the loan balance growing too fast, too quick. And depending on the structure of your personalized HECM and how you treat it, and there's a lot of flexibility and room for customization on this, the loan balance will grow a lot, a little, or potentially even decrease over time. When you move out of the home, pass away, or if the home falls into disrepair, the loan will become due. And on most HECMs, the home is then sold, and from that sale, the loan balance is paid off first, and then any remaining equity goes to you if you're moving, or to the estate or heirs if you've passed away. And here's an important piece that a lot of people miss. HECMs are non-recourse loans. So that means your heirs will never owe more than the home is worth. And that's true for you too. Even if the loan balance does end up higher than what the home value is worth, you can't owe more than the balance. Now, myth 5, if the loan balance grows beyond the home's value, you're forced out. Fact, that's not how it works. There's no trigger based on loan balance. As long as you're meeting the basic obligations we talked about earlier, you can stay in the home. The balance growing over time is very common and expected. That's part of how this product is designed to function. Myth number 6, this is a last resort option for people in financial trouble. Fact, many financial advisors are starting to include HECMs in their retirement planning due to the line of credit. For some homeowners, it's about creating additional cash flow, maybe reducing monthly obligations, preserving other assets like on the stock market through managing sequence of returns risk, or just increasing flexibility in retirement because they don't know what's going to happen in later years. Now, it's not right for everyone, but it's also not a sign that something has gone wrong. Myth number 7, taking money from a reverse mortgage will impact my Social Security or Medicare. Fact, money taken from a reverse mortgage is considered tax-free loan proceeds. You don't pay tax on it, and it doesn't factor into Social Security or Medicare. This is another reason that financial advisors are starting to recommend HECMs more frequently. Myth number 8, interest rates on reverse mortgages are very high. Fact, not true at all. In fact, HECM rates are often very comparable to interest rates on traditional forward mortgages. Since these are FHA government insured loans, there's less risk for the lenders, so they're actually able to offer better rates because of that. And also, if your HECM has a line of credit on it, higher interest rates aren't necessarily a bad thing anyway, because the line of credit will actually grow based on that interest rate, but that's a topic for another video. Now, reverse mortgages, especially HECMs, are one of the most misunderstood tools in the mortgage world. And when something is misunderstood, it's easy for fear or bad information to fill in the gaps. The goal here isn't to convince you to get one. It's just to make sure that if you ever consider it, you're making that decision based on facts and not myths. I feel really passionately about this because it's affected me personally. Some of the older people in my life that are close to me have used these to avoid losing their homes and alleviate the pressure and stress of financial hardship. I've also watched seniors sell homes they love because they couldn't afford the mortgage payment anymore and they didn't think there was another option. And in some of those cases, a HECM loan would have allowed them to keep the property and live out the rest of their lives there. So I encourage you, if you're 62 or older, to really explore these options and see if they make sense for you. Now, don't let anybody pressure you into anything, but give it an honest evaluation before making a decision on anything. And if you're trying to figure out whether this could make sense for you specifically, I think that's a conversation worth having. You can schedule a call with me using the link in the description below. My team at Barrett Financial are reverse mortgage experts, and we focus on providing education, clarity, and the customer service you'd expect from someone helping you make such a big decision. So reach out to us if you're interested, and until next time, take care.